kind of advice do you have to homeowners?
Practicing that preparedness. Starting the conversation now is always going to be a benefit to any association out there.
And welcome to Recovery Report Live. I'm Dan Odess, president of GlobalPro, where we manage risk to recovery. And as you know, we've managed more than $1 billion in that recovery, and we're celebrating 10 years this year. Last week was our 10-year anniversary, and we're excited for it. Our whole team got together. We celebrated, rejoiced. We are so grateful for all of you that continue to tune in to this show. We got an incredible show today. I'm going to jump right into it and invite our guests on because there's a lot of important information. If you're tuning in, you're probably a property manager, you're maybe a unit owner, or a community association board member, whatever it may be, you definitely want to know this information, whether it's you're in Florida or throughout the country. We all understand that a lot of times what happens in Florida, particularly when it's community association or construction related, at some level gets adopted throughout the country, as I have seen it firsthand. So I think there's some really important information, and I want to make sure that we're spending a lot of time with our guests. So I'm going to get right to this show, and I want our guests to join us here. We have Mark Anderson, we have Josh Burkett with Mark Anderson Consulting, as well as Rafael Aquino, a guest that's definitely been on a few times with us, with Affinity Management, to talk all about these. So gentlemen, thank you so much for joining us today.
Thanks, Rafael.
Thank you for having me, Dan.
All right, so we got some really important information here. Mark, I want to start out with you to talk a little bit about what actually happened. I think it's kind of a loaded question, so we'll give you a few minutes to respond as to what happened this session, specifically as it relates to community associations and some of the construction stuff and how it may impact our community here, or what to expect.
Well, hey, it's good to be with you, and we're still sorting out a good bit of what happened during the 22 legislative session. The headline is the Surfside bill that we discussed last time on your show did not end up passing. We had different versions of that bill circulating, very different approaches in the House versus the Senate. Overall, though, I think we did, in fact, make some progress in advancing this idea that we've got to do more to encourage these communities to begin reserving their funds to responsibly take care of these buildings so that we don't have another Surfside in Florida or anywhere for that matter in the country. And as you pointed out at the top of the program here, Florida is a bellwether state for so many other states in this area. And as we learned during session, Florida is also an outlier when it comes to this issue of reserve funding. By allowing this waiver of reserves, Florida is the only state in the country that allows that. And so that was really where I think the two chambers diverged. There was wide and strong agreement on the issue of disclosure and transparency to prospective buyers and current owners inside of buildings to be able to know that the buildings they're living in or want to live in are safe. They should know whether or not a building is reserving its funds, and they should know how frequently that building has been inspected. There was also wide agreement among everyone on the issue of more frequent inspections, particularly for buildings that were within 3 miles of the coastline, where you see accelerated types of erosion on buildings because of the saltwater intrusion and things like that. But then that third leg of the stool, which was the reserve funding, we saw a very different approach. The Senate wanted to make it more difficult to waive reserves. The House wanted to prohibit it altogether, with very little, if any, option for communities who cannot assess their way out of it. And I think that really presented a problem. But I think in all, both chambers wanted to do the right thing. They wanted to make it more difficult to waive reserves. I just don't know that they quite understood how to get there with the limited amount of time that was available to us during the session. That said, that bill will come back, and it will come back. And the issue is going to be, once again, the issue of reserves and what does it look like for communities who need to be, number one, getting reserve studies frequently, and then two, you need to be reserving your funds for maintaining your building immediately. I think that this bill is going to be back, and it's going to, again, be incumbent on those of us in the management community and among the community associations as well to really inform our lawmakers that of the best path forward when it comes to reserve. I think largely there's agreement on 9% of what needs to be done. But the reserve issue is the cost of living that's going to be impacting so many Floridians who live in these buildings. And I think we want to take a very thoughtful and deliberative approach on that. And I think the two chambers are going to take their time in this interim time that we have to really strike that balance and achieve something good for our communities.
No, I can't agree with you more. I was obviously reading some of the pundits and some of the headlines and some other articles and opinions on, and I definitely saw some disgruntled editors and some people sharing opinions about, how disappointed they were that they didn't get this done. I've experienced Tallahassee personally. I've been up there. I've worked with lobbyists. I think this is such a touchy issue and something that does require a considerable amount of thought. And this isn't something that was going to get decided overnight. I too agree with you that I think a lot of it came out of it. I definitely think the issue, I think they were at a minimum or at most, they were at least able to kind of whittle it down to where the issue is amongst all of the bills and the proposals that were out there. So I think it was a great amount of progress that was made. I don't think that as many people should be as disappointed as they were that a bill didn't get decided just that. I think it would actually be even more people more disappointed had they actually agreed on something. I actually think that there was a lot of thought that was going into this, and I definitely applaud a lot of the efforts and was excited to see and encouraged by it. And hopefully we'll see what happens next. But Mark, one of the other things that we were hearing about was this whole Freddie and Fannie thing that was occurring kind of right before or during the session. How do you see how this has changed the condo market, and did that weigh on the legislators at all during the session?
I think it did. I think it, as we saw, and as we will see now in this interim period of time where we still don't have a Surfside law in place, you're going to see a lot of the markets, whether it's insurance or whether it's Fannie and Freddie Mac, Fannie Mae, sort some of this out on their own by requiring more transparent disclosure of the state of these buildings. They don't want to loan money. This is a high risk for a lot of these buildings, and you're starting to see the lenders and you're starting to see the insurance markets react to our markets and our condo markets in Florida ahead of any law that would do a lot of what they are already doing right now. It's going to have a major impact, and I think it's also really important for our owners and for our managers to understand that the cost of living for everyone living in condominiums is going to go up. No matter what we do, if a no bill passes or if a bill passes, it's not a matter of if, it's how much the cost of living is going to go up, whether it's higher insurance premiums, whether it's more higher assessments, or just more reserves being provided for. The cost of living in Florida community associations and condo buildings is going to go up. And I think we're going to begin to see some of that already taking place. The markets, as you pointed out, they're already requiring a lot of these questionnaires that will provide these lenders with a lot of information about the state of these buildings. And it's really, I think, forcing the issue into the open now, with or without a bill to do that.
So Mark, you mentioned a couple times insurance, and Josh, I want to bring you into the conversation here, a little bit, talk about it. Obviously something near and dear to the insurance coverage experts at GlobalPro, definitely an important issue, something that we were closely monitoring. The changes that were expected, some of the things that were being proposed, highly controversial from a policyholder advocate's perspective. I think the industry was pushing for a tremendous amount of change. So talk to us a little bit about what failed, what happened, where do you think the issues are, and what to expect on an ongoing forward basis. Are some of these things going to come back? Do you think there's some middle ground that we can reach between the industry and the consumer? What are you seeing there as it relates to the insurance?
Well, Dan, you're absolutely right. I mean, in Florida, the property insurance market is really in a free fall and a crisis. I think most of our communities are experiencing either higher increased premiums or having difficulty finding coverage at all with admitted carriers. And the real issue has been litigation. So from the insurance company standpoint, Florida accounted for about 8% of all property insurance claims across the country this past year, and accounted for 77% of all litigation. So from the insurance company's perspective, we have a litigation problem. And so one of the ways that they tried to curb that was roof claims. So not not like your hurricane events, but your wind events, your $1,000 deductibles. And so they've thrown out a couple options with having like actual cash value for your roof. You know, once your roof hits 10 years old, you're going to get a sliding scale, and you're only going to be able to recoup, 70% of your roof's value in year 11, and it's going to go all the way down to year 20. Another thing they looked at is changing up the deductible for roofs to 2%, similar to a hurricane deductible. And the reason for this is you do have contractors in the marketplace, who say, hey, let me get on top of your roof and take a look. You got a tile missing here or there. Give us your $1,000 deductible and we'll go ahead and get you a brand new roof. The issue with this for community associations is, the insurance companies are kind of tying it to the auto insurance market, right? Your car's worth 10 grand, you get into an accident and you get a $10,000 check from your insurance company. Well, you can't buy half of a roof,
right?
So that's kind of where that becomes an issue. And that was the big sticking point, is what to do about the roofs. So, the Senate was on board with some type of sliding scale or different deductible, and the House did not agree. The governor had a press conference yesterday and mentioned that he would like to see a special session, maybe after the election sometime in November, to handle the insurance issue. But, from a real world standpoint, I think Rafael can kind of touch on this a little bit. Associations need to be mindful of the age of their roofs, and also, to Mark's point, be putting money in reserves probably well in advance of what they're doing right now. Your roof that has a 30-year lifespan, you might not be able to get coverage or actual replacement value of the roof here in the near future.
Yeah, and the premiums are still going up. So we're more money for the cost of the insurance, less coverage seems to be the trend, less consumer protections, and unfortunately less reporting by insurance companies. And it's kind of Mark's point earlier, where there, for community associations, with regards to waiving the actual these reserves, and we see somewhat of a similar issue with regards to the reporting requirements of some of these insurance companies, and the basis as to why they're asking for the rates. Now, that's from the consumer perspective, as you were talking about the industry, the insurance company perspective, just kind of giving the contrast there. From the consumer perspective, we're like, well, start reporting more of this stuff. Where's the profit going? Where you're reporting these things? And then from the industry side, they're saying, oh, there's too much litigation. It's too much litigation. I was literally just in a deposition this week on an issue regarding a roof, and during Hurricane Irma, there was literally blown out windows in this building, and the insurance company still used the limitation on wind-driven rain to cap the recovery for the association. It doesn't make sense, right? We have obvious blown out windows, and they're using a $500,000 limit on wind-driven rain to pay the claim. So, and of course, that claim ended up in litigation. So I think some of the practices of some of these insurance companies, but to your point, that was a non-admitted carrier, right? So they're not held to the same standard. And worse, this policy actually had arbitration. That was the law, the choice of law was New York. So the seat of the arbitration was in New York for a Florida claim for a Florida association. There's some funny things in these non-admitted policies. And so yes, we want to attract more admitted carriers down here. We want to see more of this. Well, but from a consumer perspective, we want to see more reporting. We want to see a little bit more honest accounting of these things. And I don't think that the sliding deductibles and the ACV and this complicated schedule of how you're going to get paid on the roof is actually going to work. And I know a lot of consumer advocates like myself agree on that. So that's why that disagreement's there. That's clearly why those things are failing. But yeah, there's an enormous amount of litigation. I personally can't explain it either, but except for in our obviously experience, and gave you one example there of where an insurance company, non-admitted insurer, is using language in a policy incorrectly to limit the recovery for an association. So, there's a lot of things that need to change. There's not going to be a silver bullet, and I think that's what this is all about. It's awesome to have on Mark Anderson, government consulting, guys like Josh and Mark to talk about these things. I think it's so important. Part of an incredible organization, CEOMC. If you don't know what that is, you didn't hear our earlier broadcast, go check it out. And I want to bring Rafael in to talk about some of the things that he's seeing on site, on the associations. How are they perceiving these changes from a management perspective? What do you think is where are the touching points for some of these community associations? What are some of their feedbacks about some of these bills? And how do you think it's going to impact the operations and the services you're providing?
Sure. So I'll start off with the what's actually impacting right now, and it has to do with those Fannie Mae notices that we're receiving, or I should say questionnaires that many associations are receiving. In most cases, most owners are going to use a government-backed loan, which is through Fannie Mae. So we've had a major increase in these questionnaires, and the challenge with the questionnaires is just the questions that they're asking. You know, they're asking the right questions, right, from an underwriting standpoint. But the questions are very vague, and you have to be very careful in answering those questions. So we're having to get our association attorneys involved. And some of the questions are, you know, when was the building last inspected? Is the building structurally sound? Well, that's a very open-ended question to just have a manager or a board member fill that out. And God forbid something did happen, you know what, if you answer that question that it is, you're going to be on the hook for it. So it's been a very challenging time both for board members and managers and even new buyers, because if a building has just a basic, let's say a basic report that it's been inspected and it's doing okay, that doesn't necessarily mean that we're going to sign off and say that the building is structurally sound. So, you know, that needs to get itself worked out. But ultimately, as Mark and Josh both mentioned, this is going to get they're going to work out what they need to work out, these banks. They're going to do what they need to do to protect themselves. So ultimately, even though the bill did not pass, the board members and owners need to take into consideration that it's not over, and you need to do what's right for your community. It is a shame that the law didn't pass, but hopefully, as Mark and Josh mentioned, things will continue to iron themselves out, and we'll get something hopefully sometime next year. But we do need something, because not all associations don't have reserves, but a significant amount of them do not. And when you look at the percentages in comparison to the rest of the country, you'd be surprised at how low a percentage we have in reserves compared to the rest of the country. And all that does is really create challenges, not just for management, but more importantly for these residents, because, you know, many times when they're purchasing these units, they're not digging in to understand what's the true condition of the building. And then by the time they find out, they're being slapped with either a special assessment or a loan, and then it just trickles from there. So you're paying interest on really bad decisions that were made throughout the year, throughout the years, I should say. So what we're seeing on the ground is right now the impact is directly that has to do with the questionnaires. I do see that some potential changes coming there, but it's not going to relieve it. Our recommendation right now to our clients is really moving forward as if the law had passed. So getting the reserve studies if you don't have them, understanding what the potential would have been if the law did pass, whether it was going to be with a sliding scale or all at once. So then that way you're preparing your communities, because there is change is going to come to our laws, and it's better to prepare now and understand what are the conditions, what are your financial conditions, what you should be putting away, and what steps you need to take to be able to have some kind of catch up. As Mark mentioned, I'm hopeful that that we made some strong progress. That our legislators understand that we need this. They understand the impacts that it has to our association. So hopefully next year, with the work of CEOMC and the residents and the board members speaking up, that we can have some positive change for our communities.
Yeah, and a lot of changes coming. One of those other things that are changing is the construction defect. Statute 558, if you're in the community association world, you know that all too well. If you're in a newer building, you probably cringed when I said it. It's definitely a difficult process, a very expensive process. Unfortunately, it's become quite a cottage industry for some engineers and building consultants, running up a tremendous amount of expenses, both on the defense of the developers and contractors as well as on the association side. A lot of times, because of that, there is no resolution to it. We have perfected a way in which to recover for these things through insurance. I still to this day scratch my head as to why these things are not adjusted, because we do know that insurance companies are stepping up to defend and pay these claims more often than ever before. But that aside, Josh, I want to bring it back to you and talk to you a little bit about what is the change that is being proposed there. It was a bit confusing to kind of understand it and how it may impact community association, but I do know it is a big change. So what's your perspective on what is being proposed on the construction defect side of these bills?
Well, then it came down to two separate things, right? So you had one statute of repose for latent defects. Currently right now it's 10 years. And the other part, as you mentioned, was the 558 claim process. So, on the one hand, you had the developers who said that the statute of repose was too long and 558 was too complicated. And the point of 558 is to curb litigation, and they weren't seeing it. So they proposed a couple of different changes. One of the issues that the developers saw was people getting money to make repairs and then not making the repairs and pocketing the money. And then on the latent defect side, they wanted to bring down the statute of repose, and they had thrown out 4 or 5 years. So from a community association perspective, our biggest focus was on the statute of repose for latent defects and as it relates to turnover. If you had a statute of repose for latent defects at 4 years, some of these communities wouldn't even experience turnover from the developer until after the statute has run out. And so then all of a sudden you're getting common elements, a clubhouse, and you're going to have no recourse if there was shoddy work done by a developer. And then on the 558 side of it, the House took a different view than the Senate. They said, well, if 558 is broken, let's not fight over how to fix it. Let's just repeal it. Just get rid of 558 and go from there. And the Senate and House really were stuck on what the years are going to be to mess with the statute of repose, and then what to do with 558. And the Senate passed their bill first, and they had the statute of repose at 7 years, no matter what. And they redid 558, and then the House amended their bill and repealed 558 and took the statute of repose. They kept 7 years for single-family homes, but as far as like turnover for associations, they went to 7 years after turnover and gave a safety valve to where if there was negligence found, like if a developer intentionally tried to hide something, the statute of repose actually went out to 15 years. Wow. And so the Senate and House, again, just could not come to an agreement on construction defect this year. And so that bill failed to move forward. But as you know, Dan, there's a construction defect bill every year. Yeah. So I'm sure it will be back next year.
Yeah, unfortunately, it definitely seems like something that's constantly attacked. If you do read that first paragraph of the 558 statute, it says 3 times in it that the whole point of this was to avoid litigation, and we all know that's not what happened, or what is happening. It definitely needs to be fixed. It's definitely broken. You definitely see some industry, I would say consultants or whatever experts that have gotten involved in it, certainly taking advantage of those opportunities. And unfortunately, it's at great expense to these not-for-profit community associations, these communities, these vertical residents where people are trying to live together. And I too often see board transitions occur due to alleged mismanagement of these 558 lawsuits and these litigations and everything else. So it is a touching point. It's a huge financial strain on associations. It's also emotionally straining on your fellow neighbors. So hopefully they can figure that all out and clear a path forward. I know one of the things that they were proposing was this 90 days to execute and start repairs and complete the repairs in 1 year. It just, right now it would be almost impossible to do something like that. The limitations on materials and labor and just the sheer cost of construction is changing every single day. And obviously I know that very well, being a general contractor and actually actively having job sites. Let's just say I ordered appliances for a job site. They told me it was going to literally be 4 months, and we are sitting here today, 8 months later, I still don't have them on the job site. So the idea that you're going to actually start these repairs in 90 days, or execute a contract in 90 days, when you have to vote for quorum and you got to do all these other things, and then you're supposed to even start the repairs within 1 year. Steel and concrete, it's just very difficult to get your hands on. And if you can get them earlier, you're usually paying even more money for them. Then there's a dispute over that. So there's a lot of inherently wrong things with what some of the things that are being proposed. But it is definitely broken. It definitely needs to be fixed. I applaud all of your efforts in doing that on behalf of community associations. If you don't know what CEOMC is, go out and check it out. Google Josh and Mark's names and definitely check into that organization. They are out there advocating for you as community association experts and on the legislative side and making sure that your interests are being protected. They're out there representing it and giving us this great information. One of the other things I wanted to bring up before we transition it and close out the show here is just the sheer cost of living. And it's something, Mark, you mentioned earlier. And I definitely think this is weighing on a lot of people's minds. How are they going to pay for these things? How is that something that's being discussed, Mark, by a lot of the legislators up there as they're proposing these things? Is it a big issue? Do we think with the rising rents and the increased HOAs? I mean, how is that playing into the decisions that the legislators are making right now?
It's Dan. It's probably the primary focus of our legislature, and I think we saw that play out during the debate and the discussion of the House and Senate versions of this legislation during the session. It really did weigh heavily on the discussion. You have to balance safety, which is obviously something we have to deal with the cost of living. And if you, as often government can do, even if it comes from a good place, if you overcorrect, if you overreach, you could actually have the very opposite and harmful effect on the very people that you're trying to help by pricing them out of their homes. We saw this happen in Surfside itself. We saw a building that waived its reserves year after year. And then we saw them realizing they can't, that's not sustainable. They got to the point of assessing their owners in the amount of 6 figures per unit, and they couldn't pay for it. And what we would see throughout the markets in Florida, in the condo markets in Florida, would be to price people out of their condo units. And then you've got buildings just sitting. What good is that going to do? It's not going to do any good at all. So the cost of living is a major focus of the legislature. I think the Senate wanted to take a lighter touch on this issue of reserve funding, which is directly related to that cost issue. And the House wanted to get a little more rigid on the issue of not allowing them to waive it at all and give them 2 years to kind of catch up. And then in July of 2024, you would have to begin reserving quickly. So I think in terms of the cost, the only way to really ameliorate that is for these communities, as Rafael just mentioned a few minutes ago, you need to start reserving your money now. As you do it, the sooner you do it, the less it's going to cost you in the future. I think it's going to be a higher cost. It's a matter of just how much higher that cost is going to be. But I think the sooner you start, the less it's going to cost you in the future. And I think that's really the only answer here. But I think the legislature looked at that and said, look, we're not going to shock the system out of existence here by pricing people out of their homes. Let's do something more reasonable. But I think we'll get there. I think the two sides will get together during the interim. We certainly will be at the table talking to these decision makers and letting them understand what a reserve study is, what are reserves, what are they not, and how can we best serve the people that are most impacted by this legislation, people who live in condos, and doing so in a way that's going to enable them to have a better not only cost of living, but a better quality of life as well.
So Mark, how can our audience find out more about what you and Josh are doing and about CEOMC? I mentioned just Googling it, but I'm sure there's a better way. How can they get in touch with you all and find out what you are doing right now to help community associations?
Well, one thing they could do is go to our website, CEOMCFL.com. That has all the information about our industry there. But also, if you are a community that does not have a professionally managed management company, I think you should look into retaining a management company to help you navigate the many different things that are coming in the future with respect to this Surfside bill we've just been talking about. Managers, I think, can be a very huge asset in this discussion and this navigation with you. But have a management company work with you. Take a look at our website. We've got some great ones in our industry, ready, willing, and able to do that. And then to tune into shows like this. Dan, you're doing such a great job in informing folks of what is going on, because it is so critical for people to stay informed of what's going on, because it just has such a tremendous impact on our daily living. So I would say pull up our website, take a look at that. If you got any questions, obviously we'll have our information available to you, Dan, and to your folks. We can certainly do what we can to help.
No, it's been an incredible conversation. You mentioned about management companies. I know that sometimes the association will bring that management in-house. I just sometimes I struggle with it because the limited availability of resources. When you have a management company that's there, that has resources, that actually has people that are actively doing this and then disseminating the information to the on-site people, it's a dramatic change. So Rafael, tell us a little bit about Affinity and what all you all are doing to update and educate your community associations, your boards and unit owners, and how our audience can get in touch with Affinity to find out all about the great things that you all are doing.
Sure, thank you, Dan. Yeah, so basically what we're doing is really just, again, as I said earlier, just taking that proactive measure. We've spoken with several reserve study companies, and they're giving us discounts because of these bulks deals that we're trying to work out for all of our associations, and just really promoting this to our associations, saying let's take advantage of this now. Ultimately, the cost of a reserve study, we've spoken about it so much today, the cost is very minimal compared to the value that you're going to receive. As a board or a manager, you're going to have a better understanding of some basic life expectancy, the potential cost of what these items are going to cost at that particular time. So it's a great tool to be able to communicate with your residents as well as with any potential buyer or seller. I would completely disclose that information earlier on so that they understand what they're getting themselves into, whether it's good or bad. But ultimately, as Mark mentioned, the cost of living is going to go up outside of the bill itself. I mean, we have inflation. We have right now the demands of so many community associations doing what they need to do with their inspections. There's such a limited right now amount of contractors that are qualified within our industry to do the work that needs to get done. So that has already pushed prices up. So one way or another, whichever way you cut it, the cost is going up. The right thing to do is just be proactive and start taking the steps that you need to take. For the board members listening, I always like to mention this piece because this part always gets missed, is you could actually, if you don't have reserves, you could actually propose reserves and not give the owners the option to vote it down if you want to do it in small steps. And in my 15 years of doing this, I've never seen a membership come back and say, no, we don't want that. They've actually just dealt with it. It's been a month or two of back and forth complaints, and then they move past it and they understand that that's an expense. So, there's different ways of approaching it. But again, I'm a little biased because I own a management company, but definitely having a management company that's really involved in the industry, does things like this and getting on shows such as yours, then there's a lot of benefit and value that they're going to receive. How they can reach us, very simple. They can visit our website, managedbyaffinity.com, or you can also call us at 800-977-6279. Thank you, Dan, for having me, and I do want to congratulate you on your 10 years of advocacy. You guys have been doing a great job on the program that you do and the team that you have, so I just wanted to acknowledge that.
No, I appreciate that. Thank you so much, guys. Thank you, Josh. Thank you, Rafael and Mark. This has been an awesome show. This has been, it might not be the most exciting and sexy topic and really get you the energy up and the heart pounding, but definitely important. And we obviously are expecting a lot of changes to come. They're expected to call some special sessions to actually hear some of these things. We'll see what happens. We'll see what changes are going. We're going to keep on reporting on it. Maybe we'll even have you guys back for part 3. I'm sure it'll be there in the future. It's always a pleasure to have all of you guys with me. I think this was an incredible and valuable broadcast. I think it's something that a lot of people are going to watch, tune into, share. And so, again, guys, thank you so much for joining us here today.
Thank you, Dan.
Appreciate it.
All right, what a great show. Awesome information. That was part 2. So if you didn't see part 1, go check out our YouTube channel. You can head over to youtube.com, look for GlobalPro Recovery. You're going to see it there. It talks about what was going to be proposed or what was being proposed, and now you've seen the end of session and what didn't pass or what the feedback was as what it's going to take for some of these things to pass. So you had 3 of the top individuals in this industry reporting to you about what just happened in session. But there's more to come, and we're expecting changes to happen, and we're very excited to have people on like them who are there, right there on the front lines, giving you this information in real time. This is a live show. We're here every Thursday at 11 o'clock, and if you haven't already, like us and follow us on all the social media to make sure that you have all the information you need. And like I mentioned before, we are in our 10th year. We're continuing to celebrate it. I mean, we're having parties, we have galas coming up, we have other events, we have tons of charity stuff. So if you're not following us on social media, if you aren't checking our website, you're not going to know about it, and you're going to be out of the loop. So we want to make sure that you're in the loop. So make sure you go ahead and like us and follow us on all those social media, and tune in every single week right here, same time, same place at 11 o'clock on the Recovery Report Live. Thank you all for joining us, and thank you for our special guests for being here today on this important topic. And we'll see you next week right here, same time, same place.